The financial leverage ratio is a critical measure used to assess the extent to which a company relies on borrowed money to finance its assets. This ratio is particularly valuable because it offers insights into the risk associated with a company's capital structure. Unlike liquidity ratios, which focus on a company's ability to meet short-term obligations, or profitability ratios, which evaluate overall profitability, the financial leverage ratio specifically highlights the degree of financial risk due to debt. This focus makes it a vital tool for understanding how debt impacts a company's financial stability. Financial leverage ratio. The financial leverage ratio gauges the proportion of a company's total assets financed through debt. It essentially reveals how much debt is used relative to equity to fund assets. This ratio is calculated by dividing a company's total debt by its total equity. Total debt includes both short-term and long-term debt, while total equity represents the shareholders' equity in the company. To calculate the financial leverage ratio, start by determining the company's total debt, which includes all types of borrowed funds. Next, find the total equity, which is the difference between total assets and total liabilities, or the amount invested by shareholders. Divide the total debt by the total equity to obtain the financial leverage ratio. For instance, if a company has total debt of $500,000 and total equity of $250,000, the ratio would be 2.0. This indicates that the company has $2 of debt for every $1 of equity. Example. Consider a company named XYZ Corporation. It has total debt of $600,000 and total equity of $400,000. To calculate the financial leverage ratio, divide $600,000 by $400,000, resulting in a ratio of 1.5. This means that XYZ Corporation is using $1.50 of debt for every dollar of equity. In comparison, another company, ABC Incorporated, with total debt of $300,000 and total equity of $600,000, would have a financial leverage ratio of 0.5. This suggests that ABC Incorporated is less reliant on debt relative to its equity compared to XYZ Corp. Low financial leverage ratio. A low financial leverage ratio indicates that a company relies less on debt to finance its assets, suggesting lower financial risk. This can be favorable as it implies that the company has a strong equity base relative to its debt, making it more resilient to economic downturns and less vulnerable to fluctuations in interest rates. A lower ratio often means that the company is less likely to face difficulties in meeting its debt obligations. High financial leverage ratio. Conversely, a high financial leverage ratio signifies that a company relies heavily on debt to fund its assets. While this can enhance returns on equity during favorable economic conditions, it also increases financial risk. High leverage means that the company is more exposed to interest rate fluctuations and economic downturns, which can strain its ability to meet debt obligations. This increased risk might deter investors and could potentially lead to financial instability if not managed properly. How can companies optimize financial leverage ratio? Reduce debt levels. Companies can lower their financial leverage ratio by paying down existing debt or avoiding new borrowings. This reduces the amount of debt relative to equity, improving the ratio and overall financial stability. Increase equity. Raising additional equity through issuing new shares or reinvesting profits can increase the total equity. A higher equity base reduces the ratio, reflecting a stronger financial position. Improve profitability. Enhancing profitability can help companies generate more retained earnings, which boosts equity. Higher equity, coupled with stable or reduced debt levels, can optimize the financial leverage ratio. Key takeaways. The financial leverage ratio is a crucial measure for understanding how much debt a company uses relative to its equity. A higher ratio indicates greater reliance on debt, which can increase financial risk, while a lower ratio suggests a more conservative approach with less risk. Companies can optimize this ratio by reducing debt, increasing equity, and improving profitability. The ratio reveals the balance between debt and equity in financing assets. A high ratio indicates increased financial risk, while a low ratio suggests lower risk. Optimizing the ratio involves managing debt levels, boosting equity, and enhancing profitability.